In this video, the latest in our series on trading psychology, we're going to look at the problem of taking profits too quickly. Hello, I'm David Jones from Capital.com, and in this latest video, we're going to take another look at a different aspect of trading psychology. We'll talk about taking profits too quickly. I think when you first start trading, you think, well, surely this is easy enough. If I have a profit, I can just decide when to take it and everything's going to be fine. Of course, the issue is something a little bit bigger than this, and snatching up profits can have a massive impact on the successfulness or otherwise of your trading. So first of all, let's just start off looking at the basics. Why is taking profits too quickly such a big issue when it comes to trading? Let's look at some of the problems of taking profits too quickly. So there are many studies out there that show this is a really common mistake, particularly I think for many new traders. Let's say that the average profit realised on a trade is £100. It's not unusual then for a trader to have an average loss of £200 on a losing trade. If we looked at a group of trades, it wouldn't be surprising to see losses that were almost double the average winning trade. And of course, if your average loss is double your typical profit, then you can see that you need to be right an awful lot of the time just to break even on your trading. So this problem of taking profits too quickly is something that needs to be addressed if we're going to be successful traders. So why do people do this? As with so many things with trading, it's down to individual psychology. One of the main reasons is fear. This plays a bigger part than you might expect when it comes to trading. So our trader is sitting on a profit and then starts to worry that the nasty market is going to take away their hard-earned profit. This is where the fear comes in, the fear of giving up the gains made so far. But of course, markets don't move in straight lines. Winning trades will usually require patience from the trader, which is a difficult skill to master. So a few reasons there why snatching at profits really has to be avoided. But let's take a look at a real world example. Let me walk you through a market and show what the impact would have been of taking those profits too quickly. Let's use the dollar Japanese yen rate as our example of how we will often get sucked in to taking profits too quickly. So this is a daily chart. We've seen the price has risen over the last couple of months, sold off for a couple of weeks, and it's bounced back. So we are deciding that actually this trend is still up. So we'd like to buy in. So we're buying in just above 109.50. We're seeing this as a longer term trade, trying to catch the next swing higher. So we're going to put our stop loss below these old lows from about a week ago, just below or ahead of the 108 mark. So there's our trade. We're in above 109.50. We've got a stop about 150 points away in this example. And clearly it's a volatile market. I don't think that's a ridiculous stop for a market that moves like this. Let's jump forward in time. So we've moved forward a few days, and so far so good. The market has moved about 60 or 70 points in our favour. So our view on the market has been right so far, and we're sitting on a bit of profit. So the trade's going well. Let's jump forwards again. It's on these sort of moves that can cause people to get spooked out of what are good trades. So the market has sold off. It's actually gone back to where we bought in, and a little bit lower during the day. So some people may well have been tempted to snatch at the profits as the market was selling off. So their plan has gone out of the window. They've seen their 70, 80 points of profit getting eaten into. They've panicked and sold out for a small profit, or maybe even at break even. Let's jump forwards again. So they're out of the position now. Now this is an extreme example. It was this area we were looking at here. The market did go on to recover and eventually moved an awful lot higher. In the end, about another 250 points away from where the trade had been opened. But it does illustrate the risks of getting shaken out of trades too early, taking your profits too quickly and not being in for the bigger move. So clearly we need a strategy to try and eliminate that, a more disciplined, mechanical approach about when to take our profits. So far I've highlighted why I think this is a problem. So we need to give it some thought. We need to have, I think, a more disciplined approach to deciding when to come out of a position for a profit. Here's one idea I'm going to go through to do with how far away your initial stop loss is and helping decide when is the right time to start moving it. So let's go through a few of the steps. So let's think about a possible plan for taking profits. So first of all, we have to accept that snatching at profits is a really common problem. One idea we could explore is based on moving that initial stop loss when you first open up the trade and then trailing it behind the price as the market moves in your direction. For example, in that dollar-yen trade we just looked at, the stop loss was 150 points away from the entry point. So where we got in, we were happy to risk 150 points. One idea is to not move the stop loss to break even until the market has moved the same amount, 150 points in this case, in your favor. So if you're happy to risk 150 points in this example in the beginning, if the market moves 50 points in your favor, so you're 50 points in profit, don't be too quick to move that stop loss to put you in a break-even position. Wait for the market to move in your favor at least the amount of the initial stop loss. So that's one way to avoid maybe getting shaken out of trades as we saw in the dollar-yen example. And overall, it helps maybe build some patience and give the market time to prove that our view is right and a way to try and extract the maximum profit from a trading idea. So there's one idea. If your stop loss is 50 points away, if the market moves 10 points in your favor, don't snatch the profit. Don't be too quick to move your stop loss to break even. You are happy to risk 50 points in the beginning. One idea is to let the market move at least 50 points or whatever the stop loss was before you start moving it. There's no perfect answer to this, but if the average trader is making £100 when they're right and losing £200 when they're wrong, you can see that's really not a recipe for success. So I think it would be of major benefit for all of us to give some thought about how we manage these profitable trades. We'll start wrapping things up there, but as usual, any questions or comments, leave us a message in the comments down below. We produce lots of these videos throughout the week looking at market specifics such as the euro, the pound, cryptocurrencies, gold, oil, and then psychological videos like this. And every Wednesday we do a live broadcast direct from the YouTube channel where we take a look at what's been happening in major markets. So to never miss out, just click on the subscribe button down there, and if you click on the alarm bell notification, you get automatically notified when we upload a new video. But for this week, for this session on taking profits too quickly, from me, David Jones, and Capital.com, we'll wrap things up there, and I hope you have a good trading week.